the price of office has fallen to the point where now they're bargains and people can buy at prices that will make money, even at lower occupancies. But here's the interesting thing. If you look at, say, like, again, New York City, there's a shortage of Class A office space right now. Class A brand new office space is trading at a premium, right? And nobody wants the older stuff, the crappy old stuff, right? That stuff is finally starting to trade at decent valuations so that you can rehab it, improve it, or convert it into multifamily.
Folks, I am not sure if you're going to believe this story, but it is well sourced. We now have a multifamily property selling for, get this, 97% discount. Yes, you can get the details on The Real Deal or CRE Daily. 29-unit building, East Harlem, just sold for $285,000. Folks, let me say that again. 29 units sold for $285K. If you're looking for a per door cost, that is sub 10 grand, $9,827. We're going to talk about what's going on. This is a rent stabilized building that has been caught up in, I think it's what was it? A 1995 New York law, something like that. We're going to talk to Jonathan about it, figure out what's going on. Jonathan, I don't know about you, but why weren't you bidding on that 29-unit building? I think we could have made some money.
Yeah, really. Obviously, I didn't know about it. So
you're not on the list. You're not on the list, the cool kids list.
Yeah, exactly. But obviously, when you're talking about a 97% discount, there's a lot going on, right? So it's not just the rent stabilization law of 2019, but there was a lot going on here. But let me sort of give you the context of how something like this happens. So this property was purchased, like a lot of other properties before 2019, with the idea that they could decontrol the building, right? And there used to be a mechanism for decontrolling buildings when the tenant who is subject to rent control or rent stabilization was vacated the apartment, and you did a certain amount of renovation, you could decontrol the apartment. And it used to be the case that when the rents exceeded $2,000 a month, they automatically were decontrolled, right? So even without doing massive renovation, if you had enough turnover and you were able to just, increase the rents by the legal amount every time, you could eventually get to that $2,000 a month, threshold, and then decontrol the apartment. Now, what happened was in the 2010s, there was a lot of abuse, as you might imagine, of this, and a lot of, monkeying around with people getting pretty much forced out of their apartments.
Yeah, they were strong arms.
Yeah,
bad actors doing bad things.
Yeah, it was definitely like bad people doing bad stuff to get people out of these apartments, and then so that they could renovate them and decontrol them. And so what happened was the legislature basically overreacted and overreached in response to this. Rather than going after the problem in a targeted way, they just basically made it pretty much impossible to decontrol apartments. And so what happened was a lot of people who had really bought these buildings as essentially like value add at really low cap rates, because the rents were, $1,000 a month and the market rent was 4,000 or whatever, right? They were buying on the basis of being able to decontrol. And a lot of them, just when the law came into effect, it ruined them. And then on top of it, then you had the interest rate hikes, and that just wiped out a lot of other people. So you've been seeing a lot of deals trading at very, very low basis these days, because there's a lot of distress in the stabilized apartment market, because people went into it thinking that one kind of set of circumstances was going to apply, i.e. decontrol plus low interest rates. And what they got instead was no decontrol and high interest rates, and a lot of people have just had to hand the keys back. So that's
and then the other thing that happens when you get caught in this situation is you stop doing all capital improvements.
Yes, exactly.
Then you stop doing maintenance, and then the building goes, from an okay building to a slumlord, and it just goes downhill. I know nothing about this building, but I can almost guarantee you there's probably more than $300,000 in immediate need for repairs.
Yeah, I would,
just a guess.
I've been in some of these apartments that like these very long-term rent controlled apartments where people are paying, I mean, you wouldn't believe this, but people are paying $100, $200 a month on apartments in New York City, and they are in terrible shape because it's like the landlord cannot afford to make any repairs other than life and safety. And the tenants are like, well, you know what? It's such a good deal. I'm just not going to complain. Right. And you see these apartments like really deteriorate. And then, one of the things about this 2019 law, the other ridiculous thing was they capped your recovery of renovation. So if you then went into an apartment like that basically needed a down to the studs renovation, because you look at these places and it's like the wall, the plaster's cracked, the ceiling is falling in, like horrible living conditions. And when you're talking about hundreds of thousands of dollars of renovation cost, but they capped the amount that you could raise the rent for renovation. So it basically was impossible to recoup that investment. So it just became really unfeasible. And now there's this kind of crazy debate going on in New York where landlords are saying there are 50,000 apartments being held off the market because nobody can afford to renovate them. And the other side saying, oh, that's BS. We don't believe it. Right. And
that was going to be my next comment, because I'm actually starting to hear from folks in New York about that. I didn't realize it was potentially 50,000, but you can totally understand from a landlord's perspective, it's cheaper to keep the unit vacant, which is wild.
Yeah. And you're talking about a city with a crazy housing shortage and rents that are sky high and continue to go up. Yeah. And the idea that there are 50,000 apartments being held off the market, and a lot of them are in prime locations as well. It's just mind-boggling. And there just seems to be this disconnect in the state legislature where they just basically they just refuse to believe it. Right? They just refuse to believe that this is the case. They just have this, a majority has this idea that landlords are evil and they just lie and they're not, they can't be trusted. The data is all made up, and all they're talking about now is they're talking about making it worse. Now they want to apply this statewide, and it's just, with people leaving New York primarily because of the cost of living, right? Why they want to make it worse? They just don't understand. It just makes
games, win stupid prizes.
Yes, and it's just mind-boggling to me how we got into this situation where the average person on the street in New York just does not believe that developers are trustworthy or that they serve any kind of function. And landlords, it's just nuts. And at the same time, they complain about the cost of housing, but then they complain about it, and then NIMBYism is runs deep here. I'll tell you, it just runs super deep, and it's all of this just adds up to this environment that makes it difficult to build. Although I have to say, there's also a record amount of building going on despite all of this, but not nearly enough, right? A record amount of building is not enough to solve the housing problem.
Well, I'm curious if New York is seeing this, because I see the numbers, right? I see the building going on across the country, but I think if you step back or you dig in 1,000 feet, it's not hard to realize that the stuff being built are for the rich people.
Oh yeah, I mean,
so we're building for the top of the market. We're not solving the masses, and that's a problem.
But you're also not building enough at the top to start the filtration process, right?
Correct.
So what we need here is what you've seen in, say, Austin, where they've built so much that the Class A is now pulling from Class B, right? Which is pulling from Class C, and you've got rents falling and kind of housing costs really moderating, for apartments anyway, maybe not for houses, but it's not that the wrong stuff is getting, and partially it's the wrong stuff is getting built, but partially is it not enough of that's getting built either. Right. So there's just so much community opposition to anything getting built where it's needed, and it's like some of this is going on in my neighborhood actually, where there's like the last industrial property in my neighborhood is the owners are trying to convert it into like a big apartment complex. And, the community opposition from basically, all these millionaires living in $2-3 million brownstones who don't want a big apartment building near them is, they're up in arms. And of course they all talk about, oh, they shouldn't be building luxury housing. Like, what are you millionaires complaining about? Like with your brownstones, like it's, we only want affordable housing, but which they don't want either, because they don't want those people in the neighborhood either. Right. So it's like, it's just like mind numbing. Yeah.
Well, let's switch gears. I think we are starting to see the commercial real estate market start to heal itself. For the longest time, office has been untouchable. Yeah. But I have seen over the last month or so, it is now being gobbled up in big chunks, even in markets like San Francisco. Yeah. We are starting to see players come in and say, basically, hey, I don't know if this is the bottom, but we are close enough. And, this is part of the healing process, right? You got to get to the bottom. You got to have new money come in and take on old assets, buy them at a price point that allows for revitalization or reconfiguration or whatever they're going to do with them. But it certainly sees that office is back. Even Jonathan Gray, somebody I put on the Mount Rushmore of real estate investors, is talking about no longer pencils down. Blackstone is getting aggressive and busy. So it seems like the big money players are starting to make some moves. What are you hearing?
Yeah, absolutely. I mean, the price of office has fallen to the point where now they're bargains and people can buy at prices that will make money, even at lower occupancies. But here's the interesting thing. If you look at, say, like, again, New York City, there's a shortage of Class A office space right now. Class A brand new office space is trading at a premium, right? And nobody wants the older stuff, the crappy old stuff, right? That stuff is finally starting to trade at decent valuations so that you can rehab it, improve it, or convert it into multifamily, which is something that, just a couple of short years ago, there were people with straight faces saying, oh, these buildings can't be redeveloped into multifamily because
the faceplate or whatever they call it.
The floor plate is what it's, and it's like, no, if the price
is low
enough, you can make it work. Right. And you're starting to see that happening as well. So office is benefiting from two tailwinds, one of which is the conversion tailwind, and the other is the demand for Class A office space, which is now.
Well, also let's talk return to office. I mean, Jamie Dimon is on record. I think he had an epic rant the last week or so, basically talking about, if you don't get your butt back in the office, I'm going to fire you. That's coming more and more, especially in New York in the finance.
Yeah, I think that a lot of this is coming too, and it doesn't necessarily mean that people are going to be in the office 5 days a week, but I mean 3 to 4 days a week for sure. And I think it's becoming pretty clear too that it is very difficult to develop a career from your desk, from your laptop on your sofa, right? It may be nice not to have to commute, but basically there is no future in sitting on your sofa. Right.
Well, the thing that I think is really funny to me is, if you can truly do your job from your couch, you could do that from a couch in Costa Rica, a couch in the Philippines, anywhere that is a fluent English speaking area. Your job could be done there.
Absolutely.
Your couch doesn't have to be in New York. It could be somewhere else. And that is a very slippery slope for a lot of folks that maybe they don't realize.
Yeah. And I think it's not simple, I guess you have to look at that and say, well, if that were really true, then it would probably have already happened. So there must be some reason, some value add that like an American worker provides. But I think that there's more value when the people are in the office together and having
that's the key.
And having like those kind of unscheduled conversations, like those brainstorming sessions where stuff really, where interesting ideas actually come up. Right. They don't come up on Zoom meetings, right? They come up from like people having drinks together and having lunch together and just shooting the breeze in the office. right? That's where those kind of like innovative things come. And that's where the relationships are formed, right?
I could not imagine, like, the thing I did for the last decade of my career is I turned vaporware, software on a whiteboard, into $100 million product lines. I did that 3 different times. And there is no chance in hell I could do that at the scale and speed required if everybody was at home. It's in the bullpen, fast reaction. Everybody is hearing everything because you don't know what conversation, what customer, right? You like, if you're going to take something from 0 to 100 million, you have to all be together. The information has to disseminate at lightning speed. And that doesn't happen when, you're on your couch and you're doing this and you're doing that. It's like, oh my God. I mean, like, I turned one product from 0 to 100 million in under 3 years. I don't see how I could do it in less than a decade if nobody was in the office. I mean, it's just, it's impossible. It's crazy.
Yeah. Not just that, but if you think about how people use their time, right? If you're in the office, you can have like a quick meeting, all hands, 15 minutes in, out, like, hey, come to my office for 15 minutes. Let's talk about this, get it done. When you have to like schedule a Zoom, right? And then everybody's scheduling the Zooms for a half an hour or an hour, and people wind up with their entire days filled up with Zoom calls and they're not actually getting any work done.
Nope.
Right. It's just all Zoom, because they have to keep on talking with everybody and it's like they're filling up their time with meaningless stuff like Zoom and email, rather than like being in the office, having quick conversations, getting decided what they need to decide, and then getting down to actually doing the work. Right. Yeah. So I think a lot of people are realizing this now, and that's what's behind the return to the office call. Like guys like Jamie Dimon are like, you guys got to be in the office for the magic to happen, and for people to actually get stuff done. Right. So
it's speed. It's just speed. Well, let's switch gears. Let's go back to multifamily. We have talked about multifamily Class A stuff starting to retrade. Again, you got Blackstone, you got Grant Cardone, you got Ken McElroy. Lots of the big players are starting to make moves. We're seeing 20, 25, maybe 30% discounts on that stuff to last trade. But what's going on Class B and Class C? Are we starting to see people talk about extend and pretend starting to crack? Are we starting to hear about, people starting to recognize losses? Are we still hearing from syndicators doing capital raises or, gap funding, or what's going on? What's going on Class B, Class C?
I mean, it is all of the above, right?
I like it.
So, I mean, gosh, where to start? I have been seeing a lot of people raising pref equity funds to step in. Some of whom are actually raising pref equity funds for their own deals to step in.
So talk about that. So let's define pref equity. And then I've actually started to hear about this as well. People are building pref equity for their own deals.
Yeah. So what pref equity is, it's kind of a hybrid between debt and equity, right? It is basically a kind of coupon only form of equity that doesn't participate in the upside, but it's a lot more expensive than just debt, right? So your pref equity will typically say, be charging you like 12 points a year as your preferred return. And then there'll be some kicker on the exit, like 4 to 5 points, right? So it's slightly cheaper than equity because its participation in the upside is capped, more expensive than debt, obviously, and tends to sit in between the debt and the equity. It really is like an additional form of leverage, although people often don't talk about it that way. So what is happening now is there are a lot of deals that need to be refied. They can't be refied without a capital call. The investors are not having it because either they don't think the deal is worth it, or they're capital called out because they've been capital called on so many other deals. So in order to not lose these deals to foreclosure, people are raising pref equity to step in and fill the funding gap, right? So now sometimes they're going with arm's length pref equity from a pref equity fund, but what we're seeing increasingly is deal sponsors, syndicators raising their own pref equity funds to invest into their own deals, and they're not entirely forthcoming about this. Now, obviously, the deal documents, you better believe, disclose this up at the wazoo, so nobody can ever claim they didn't know. But I think a lot of people don't know because they're not really talking about the fact that, hey, this money is going into this deal that I like over leveraged and, myself. And it's all really about the sponsors, like trying to save their own necks. So we're seeing a lot of this, but
so let me talk about pref equity. Again, I sit as an outside observer feeling for folks. So I think how I look at it is pref equity pushes down the original investors lower in the
capital stack.
Yeah. So they don't quote unquote lose, but their chances of winning go down dramatically.
Yeah.
Pref equity is essentially a capital call, just with new investors jumping in to a better position.
Exactly.
Right. The new investors in a better position. And third, really the only winner is the GP who keeps a foreclosure off their record, can live to fight another day. And the other disgusting part of this, especially if you're doing it on your own stuff, is they're probably being paid. They're probably being paid to do this.
They're making fees. Yeah, for sure.
Oh, it's disgusting. Yeah. Let me hurt my original investors by getting new investors. And by the way, I get paid. It makes my stomach hurt.
Yeah, it's and it's frankly, it's like all the same people that kind of did the deals wrong in the first place.
Yeah, you're going to do it again with these knuckleheads?
Yeah, right. And so, yeah, I mean, and I think frankly, a lot of these deals will get wiped out anyway. Like, so here, and I'll tell you, so listen, I'll tell you why they're raising their own pref equity funds too. Now, when a couple of years ago, and even before the crash happened, like the smart money starts to realize at the top that, hey, we want to get higher up in the capital stack because we know what's coming. We don't want to bear the first dollar of loss. So we want, those LP equity investors to bear the first dollar of loss. We're going to get higher up in the capital stack and use them as a cushion. That started happening even before the interest rates went up, right? Because it always does. It's kind of inevitable. At that point, if you talk to sophisticated investors, it'll pretty much tell you at this point in the cycle, you should be investing in debt, right? Not equity. Not equity. And so what happened is a lot of people went out and raised debt funds and pref equity funds. And you can kind of think of them more or less in the same way, because either going to be second position debt or pref equity and pretty much the same thing. So, but what happened was most of those funds couldn't find deals that worked because all the deals, they were looking at deals. There were very few deals where it was really like just a gap fund, like a good operator with, a decently run building, and they just needed this capital to kind of get them through, right?
Right.
Those deals just basically didn't exist. And so a lot of that money, that debt fund money, basically just went unplaced, right? On the other hand, you had these operators whose deals weren't good enough for the arm's length pref equity or debt fund players, right?
Yeah.
So they basically had to go out and raise their own debt funds to fund their own deals to keep them from going into foreclosure. Now, none of these deals are going to have a technical conflict of interest because the conflicts of interest will all be waived in the deal documents. So the sponsors are going to protect themselves, which is what sponsors always do because they write the documents. However, there is still a real ethical conflict of interest in these deals. And I'm sure people justify this to themselves saying, well, at least we're giving our equity investors a fighting chance.
Yeah,
maybe that's
of course
true.
They are.
I mean, like in the technical sense, yeah, they are. Like they're not going into foreclosure. Maybe the deals
yet,
right. Maybe if they hold these deals for 10 or 15 years, then they can pay off the pref, they can pay off the LPs, like everybody gets made whole. Maybe that's what happens. But I think some of these deals are going to get foreclosed on anyway. Right. So, and now they'll just lose their original LPs money plus their debt fund investors money. Right. And
ugly.
It's going to be ugly. Yeah.
Yeah. Well, I think we're quickly getting up on that era. Again, we're seeing more and more commercial debt kind of stack up, extend and pretend. It was over $1 trillion last year. I think it's over $2 trillion this year. I still believe Class B and Class C aren't trading, which means no price discovery.
They're being marketed. They're being marketed, but they're not trading. Right.
Yeah. So we need that. We need buyer and seller agreement. And really what we do, we need people to realize losses. That's what this is all about, is we have not realized losses yet.
Yeah. And the way that you realize losses, frankly, is the lenders force you to realize losses.
Correct.
Right? The sponsors are never going to voluntarily sell when they are going to make a loss.
The lender.
Right.
I agree.
It's the lender forcing their hand. And, usually it's like, hey, we're going to give you a chance to get out first, sell, wipe out your equity and sell, and everybody just has to take their lumps. But increasingly, I think you're going to just start to see the foreclosures as well. Right. So,
yeah, it'll happen. And again, my experience says the bank or the lenders that make the first move actually come out the best, because once this breaks, it'll be a race to the bottom as more and more institutions clean the books. And again, LPs are going to feel this bad.
Yeah. And I think, and this is going to have a long-term effect on the market, right?
Agreed.
Because it just always does, right? I mean, it did the last time, it will this time. But I think what's going to, because what happens is investors get burned, and it takes them, either they're out forever or it takes them a long time to kind of like.
You need a new generation of investors.
Yeah. And some people will be like, okay, you know what? I took my losses, but I've made money elsewhere. And like, I know this happens and I'll be smarter next time. Like, some of those people will come back, but I think you'll get a lot of people who will never invest in these deals again. Agreed. And so you have to have like a whole new generation of investors rise. And that's just going to take time. The lenders will also be more conservative. So what we saw in the GFC, or the aftermath of the GFC, everybody thinks low interest rates are going to save everything. It didn't happen last time. No. Interest rates went to rock bottom, and deal volume did not increase, because the lenders, even though interest rates were low, the lenders got suddenly very serious again about sponsor experience and about, proceeds and about all these other things, right? And they were just reluctant to lend. They got very picky about the deals they were willing to lend on. Like, they wanted to lend on high quality stuff. And the thing that people need to remember is, there was a bubble in the GFC, but there wasn't a multifamily bubble in the GFC. Right. And there was this time around. I mean, just historic volumes were traded in
the same building was sold 3 times in like 18 months.
Yeah.
Crazy.
But historic volumes were traded in 2021 and 2022. And like nothing we'd ever seen before, at cap rates we'd never seen before, interest rates we'd never seen before. All of this because of the perfect storm of COVID and the multifamily, frenzy. And the pendulum has got to swing back in the other direction.
Yeah, reversion to the mean is going to be rough.
Yeah. And so I think people just don't really, there's a lot of the combination of wishful thinking and just kind of ignorance about how markets work, because people haven't been through a cycle before. And they just really don't know what's coming. It all feels fine now because it hasn't happened, right? That's what people keep on saying. Well, it hasn't happened. It hasn't happened. It takes time for this to work through the system.
Yeah. Again, folks, this is something that has to happen. It's just a question of when. It's out there. We are starting to see office retrade, which is how we started this conversation. We are seeing rent stabilized building again, 97% discount. Why weren't we involved in that? Come on. We got to do better, Jonathan. That's your backyard, man. Come on. But it's been such a fun conversation, and we'll keep having it. Where can people find you?
Yeah. So please come join me on LinkedIn. That's the best place to get in touch with me. I would like to mention again that I'm doing my workshop once more, March 3rd and 4th. So that's next week. That is 6 figures from syndication. Basically, the workshop is about really how you can earn $100,000 in income from syndication within a relatively short time, just doing smaller deals and being able to liberate yourself from your W-2 in 2-3 years if you kind of follow the process without too much strain. So that's what I'll be teaching. If you're interested, hit me on LinkedIn. It's limited to 20 people. I think we're probably up to 13 or 14 at this point. So just a few spots left. But if you want to join that, please let me know.
Awesome. Thanks, Jonathan.